would like now to quickly introduce Serge. Most of you probably already know him, especially here in the Romandie. He's a founder and director of 1959 Advisors, his own consultancy company. He was previously in charge of asset management at Safra Sarrazin, as well as managing director of Retraite Populaire in Lausanne. Backed by 37 years of experience in banking, essentially in asset management for private and institutional clients, he has held several management positions at Banque Héritage, Union Bancaire Privée, and Lombardier. Serge is a graduate of the HEC and of the management school IMD in Lausanne. Last but not least, Serge was also the president of the SFA, the Swiss Financial Asset Association. That's a while back, and that is really how we got to know each other 25 years ago. So with that, I would like to hand over to Serge.
Thank you. Thank you. Maybe I'll stand up as well. It's going to be easier to speak. When Stephan asked me some months ago to make a short introduction to a conference around sustainable investment, sort of setting the stage, as he said, I quickly responded okay because my agenda was free on that day. But then very quickly also I realized that what should I say? What could I say that none of you already knows about sustainable investment? If we, and I guess since you're here, we almost come easily along with the fact that better protecting our planet, bringing more equality in the society, or protecting the interest of all stakeholders in listed company makes a lot of sense. We are all confronting with the challenges of implementation and execution when it comes to ESG investment. With ESG, it's very much about variety of opinion. Each can express his or her own values. In June 2021, Swiss people rejected the CO2 law concerning emission, a law that was supposed to encourage a significant reduction by 2030. At the same time, Shell was forced by court to reduce more substantially its CO2 emissions. Last year also, the International Energy Agency gave clear guidelines to oil majors to stop developing new oil and gas projects. In this context, most asset management organizations around the world continue to review quite extensively in details the way they manage portfolio in targeting better ESG scores and avoiding, for a lot of them, well-recognized polluters. ESG thematic funds collected record inflows of money, while some significant segment of the equity market was shunned by a growing crowd of investors. Fast forward May 2022, commodity prices are soaring. Defense companies are receiving huge orders from various countries that are quickly and substantially reconsidering their military options and policies. Experts are figure-pointing government and investors for underinvesting in energy-related capacities. Nuclear, gas, oil, even coal resources are now again considered as temporary solutions in a world that is still very hungry in terms of energy. Early this week, the headline of the Financial Times supplement on responsible investment was "Solving the Puzzle of Doing Good." After many years of free money, financial markets are currently dealing with more restriction and headwinds since reigning inflation has now superseded growth as the main priority for central banks. In equity markets, the price of all the winners of the recent years are correcting significantly, while under-owned energy, materials, defense stocks are soaring. The world's biggest funds focus on ethically minded investments have been battered as their significant weightings in tech stocks has left them at the center of a turmoil. All ESG indices are underperforming traditional indices, marking a sharp contrast to the recent outperformance of ESG funds. Tech stocks have typically been a big part of ESG portfolio because of their apparent attractive carbon footprints compared to other companies. Furthermore, their diversity and human rights policies are seen, for right or wrong, we can debate that later on, as more exemplary. The same can be said of renewable energy stocks or enablers of new energy initiatives that attracted so much interest to the extent that their prices reached too often insane levels during 2021. We all know that ESG investing is a significant challenge. There is no real standard, despite the emergence of so-called taxonomy that tries to define the characteristics of responsible investing. There are practices that range from best in class to exclusion to impact. While exclusions make some investor conscious happy, they do not solve the issue related to the climate transition. The shunned companies do not disappear, but they are simply owned by another type of investors. Other investors that probably are less engaged or less willing to speak with the management of those companies. A growing crowd of investors, as well as asset owners, are already complaining that ESG investments offer inadequate returns or generate significant crowding out that are ultimately compressing returns. I've just experienced several pension fund boards over the recent weeks where this kind of things start to come up into the discussion, things that didn't happen over the last 5 years. Others are even complaining about widespread greenwashing. Recently, BlackRock, a company that at least openly is in favor of ESG, came out with new arguments supporting oil and gas investment, since they are key to the path to the net zero. Europe admits that it may temporarily use coal to accelerate the replacement of energy from Russia. The S&P ESG index does include Exxon, but not Tesla anymore. Citicorp ESG analysts consider defense stock as good ESG stock under the S criteria. 2022 is clearly a year of reckoning or calling into question about ESG investments. Excluding sectors or companies that are essential to the climate transition proves to be wrong and potentially extremely damaging to all of us. Country ESG notations have failed to identify dangers and bad behaviors. Think of Russia, maybe China. ESG investing is not a guarantee for better performance or better returns. Thematic investment is attractive as long as conducted with discipline and not by propaganda. Is the ESG dream realistic? I'm looking at you. There is also, I believe, a new emerging theme now. It's all about security, cyber security, military security, energy security, food security, social security, health security. The questions to you, panelists, are certainly going to be challenging. How can we progress in the climate initiatives while ignoring or not considering oil and gas giants? What will be the roles of metals and mining in the transition? Why not increase the engagement initiatives while avoiding exclusion? ESG has turned to be very much about E, as the recent IPCC report is reminding us, but ESG is very much also about S and G. In this difficult context, I agree, you panelists will therefore be under pressure to help us understand the current ESG investing challenges, help us to design the course of the best initiatives and how best to engage with controversies and companies in banned sectors. For too many critics now, the do nothing can come back. Some are even considering that this is not the roles of companies to seek to change the world, but for politicians and governments only to regulate and set rules. ESG investing is bound to be reinvented, rethought of, and really focus on its strengths and base and fundamentals again. So now you have the challenge to try to answer some of the questions, and probably many more of the questions that will come from the crowd.
Thank you, Serge, for this excellent start of the program. Before I hand over to Timo, who is the moderator for this panel, just a quick word on his background. He's a lecturer at the Department of Management, Technology and Economics at the ETH Zurich and holds a position as full professor of management and environmental sustainability at the University of Hamburg. His research centers on sustainable finance and investments. Since 5 years, he has co-authored the Swiss Market Report for Sustainable Investments together with Swiss Sustainable Finance. For the DACH region, he and his research team are responsible for conducting the audit that allows SRI funds to carry the label Forum Nachhaltige Geldanlagen.
Yeah, good morning. Glad to be here today in Geneva and guide you through some very important questions. Maybe rephrase the question a little bit to our panelists. Just one notion from my personal own perspective is, like Stephan just mentioned, the Swiss Market Report. I co-authored this for the last 5 years. We're just about to publish a new report next month, which will be launched in Zurich. And all I can say here is, again, we see a lot of dynamics going on in the Swiss marketplace. Yeah, the offer is getting more diverse, more specialized products. So in a nutshell, there is a lot of momentum when it comes to ESG. Yeah, having said that, at the same time, I fully agree with Serge. We also need to ask some very fundamental questions when we look at the market size. So what is actually going on there? Are the propositions that we have on mind when we do ESG, do they actually hold? Yeah, are we actually contributing to solving the big challenges we face globally, but also maybe on a more national or local scale? Yeah, so with that, I would like to introduce our panelists. So we have 4 asset managers on the panel today, and then we have Inge, who later on will kind of critically also reflect a little bit on what has been said before. But to start with, let me quickly introduce each panelist. And then we do a quick round where I would like to ask each of you to briefly introduce what you do. Yeah. So we will later on come to why you think that's special and what your USP is, but just to lay out the foundation so that everybody in the room knows what exactly your approach towards ESG is, what your specific ideas is when you were setting up the funds. I would focus just on a more descriptive description of what are you doing. So shall we, Mathias, Althoff, shall we start with you? You represent Tundra. So please, the floor is yours.
Thank you. My name is Mathias Althoff. I'm a portfolio manager at Tundra Fonder. We are a boutique asset manager based in Stockholm, and we invest in what the World Bank classifies as low income and lower middle income countries. That means it's Egypt, it's Nigeria, it's Pakistan, Sri Lanka, and Vietnam. For us, ESG is really incorporated in the financial analysis we do. We see that in our markets, half of the world population lives, but they emit 10% of what we do. If they reach our level, the CO2 emissions globally will increase threefold. That is not an acceptable way for the global Earth to survive. So for us, it's very important that the companies develop and the countries industrialize in a sustainable way. So we look for companies that over time have shown profitability throughout cycles and crises, but also make something good for society. So that means that we have to be very much more on the ground. We have an office in Pakistan, we have an office in Ho Chi Minh in Vietnam, to be able to understand more what's going on. And we have to rely more on internal data than's available for more mature markets. So we very much try to be a positive factor and impacting the whole society as well as the stock exchange and the companies that operate there.
Thank you, Mathias. And as I mentioned, we will have a very diverse picture of different offers. In a nutshell, if I should remember what you guys are doing, I would say it's strong emerging market focus, which immediately raises the question, where did you get the data from? You already gave some hints, but I'm sure we will get back to that later on. Yeah, then let me introduce Stephan from Osmosis, and please let us know what your fund is doing in terms of ESG and what your visions are.
Thank you, Timo, and good morning, everyone. My name's Stephan. I'm a portfolio manager at Osmosis Investment Management. Unlike Mathias, we go to the large end of the market. So we're a research-based quantitative manager, and we specialize in the large and mid-cap of developed markets. We would love to go deeper down, but we can't get the data that we need to do that at this point. The business was founded 13 years ago, and its sole genesis was to embed sustainability drivers within portfolios. It's a simple concept, really. It's about the companies that can generate more revenue by using less resources are the ones that are going to outperform their peers over the long term. So what we do is we compare companies to their peers on the data points that we believe are important when we talk about sustainability. And those data points are the carbon emitted by a company, the water used by a company, and then the waste generated by that company, all relative to the economic value the company generates. This allows us to really focus in on those companies that are using their resources best. And that sort of focus on the economic argument here allows us to very verifiably and objectively measure companies in their sustainable criteria. And we believe those companies are going to outperform their peers over time. And our research proves it. Independent research statistically shows it true as well. And this, of course, gives two very, very strong advantages. One is that it's very likely that our clients can expect outperformance over time, and that's against whatever benchmark they choose, because we can build the fund to run against all sorts of benchmarks. So whether it's an MSCI World or it's an ESG type benchmark. And secondly, is this has a huge environmental impact as well. So typically our portfolios show a 50 to 70% reduction in your carbon footprint. And that's versus a sort of typical MSCI World type basket. So the two very, very strong advantages that we believe that we offer.
Yeah, thanks, Alex. And I would, if I now have to say what is really in a nutshell, one should think about your funds. I would say it's efficiency, eco-efficiency, this whole idea of using less resources and becoming more profitable at the same time. And I'm saying that because since we're in Geneva, also we have the World Business Council for Sustainable Development. And this initiative, well, it's industry driven, but I would say maybe like 20, 25 years ago, this initiative came up with this idea of eco-efficiency. So when they said, okay, how can we combine economic interest, profitability with becoming more environmentally friendly? So they really pushed this notion out for the real economy. And, what you were saying, I basically see this is transferred to the investment logic. So where you then would put together companies in a portfolio that follow this vision, this logic. Yeah, thank you. Okay, let's go on with Ulf Frykhammar. And please explain us quickly what exactly you are doing at Norron and what the specific features of your ESG products are.
Yeah, my name is Ulf Frykhammar. I'm the founder and chief investment officer of Norron Asset Management. Norron is only active in the Nordic regions, so the 4 markets up there. I've been a fund manager for 33 years, taking active risks in markets for more than 3 decades, long-only mandates, absolute return mandates. Had a desire to start my own company with a group of colleagues. Did that in 2010. We offer 6 funds. The bulk of our existing asset under management is Nordic and Swedish pension money. And the ESG approach is what we've developed during the years is a very active approach. You have to combine these new themes with fundamental valuation to avoid the crowding effects you're referring to. I think we've done that successfully. We'll continue to look at the valuation parameters of all the new themes that pop up in the markets.
Yeah, thanks, Ulf. And also for you, if I may, in a nutshell, as we discussed, you really look at trends and you try to understand what will be future trends and how should or could we incorporate that in our investment decisions today. Yes, then we move on to Craig Reeves, our last panelist, who is from Prestige Funds. Please.
Yes, thank you. Good morning. So my name is Craig Reeves. I'm the founder of the Prestige Group. Essentially, Prestige was founded 15 years ago. And really our largest business within our group focuses on renewable energy infrastructure. And that journey that we've taken started with providing relatively small and simple and short-term finance to the farming and food and agricultural related industries in the United Kingdom. And the philosophy there at the time was around productivity and efficiency. We can finance a new piece of equipment, machinery, or a vehicle that produces more in less time using less energy. Well, that was more than 13 years ago, and the world continues to evolve and change fast, and a lot's happened in the last 13 years. But overwhelmingly, that customer base has remained fairly similar, but their requirements and their issues have elevated to a different level. And that's partly because farming, generically, is often considered the world's second largest polluter. So other than burning coal to generate electricity, farming creates more pollution than anything else. And yet it's so critically important. So over the last 10 years, our group has evolved in terms of its size and sophistication, but it really has focused on providing a solution to farm, food and agribusiness. And so we do a lot of renewable energy and waste energy. To put this in perspective, the UK puts about 10 million tons a year of just food waste in landfill. And so that's a hole in the ground. And that hole in the ground creates a huge amount of methane gas. And methane gas, depending on who you believe or what you read, is between 25 and 85 times more toxic than carbon dioxide. And it's already a quarter of global warming. So this is an emergency. And so we go out to that community and we design for them solutions to get them the productivity and efficiency, but critically to reduce their pollution, their emissions. And this is where we're going to talk more about today, but that's the big part of what we do in our group. So we have several different funds that capture these opportunities, and we're happy to explore that further later.
Yeah. Thanks, Craig. So if this event took place, let's say a decade ago, we at some stage we probably wouldn't end up with the discussion ESG, SRI, this is just a niche market topic. And then the claim would be we need to become mainstream. If we want to be effective as a community, mainstream is the objective. I would argue we are there yet. This topic is in the mainstream. You won't find a single asset manager, asset owner who not has some sort of an ESG linked strategy or some sort of a product in that regard. And this is also reflected by last year's Swiss market report. More than half of the mutual funds in Switzerland have some sort of an ESG strategy, more than 50%. So this is clearly an indication of being in the mainstream. Having said that, I strongly believe for products to further establish, be established successfully in the market, it's very important to have some sort of a USP, to have a specific feature, so where you can convince clients and say, look, this is, the big market and everything that goes on there, but this is how we can specifically add value. We have a specific ESG approach which differentiates us really from other competitors and offers in the market. So that would be my second question to you guys. And Mathias, maybe we start again with you. So what would you say is, you already touched a little bit on that, but maybe you can build on that further. What is really the unique thing about your funds?
I think our local presence is one key matter. And I mean, obviously we travel to the markets we invest in, but it's the data availability and the research availability for the corporates we invest in is much, much less, obviously, than other more developed markets. So we can add much more alpha by doing the work ourselves, because the data is there if you dig a bit deeper. So I think our USP is that we dig a bit deeper in markets that are more difficult to access. And by being present there, we can actually add much more value. So over time, we have provided our investors with quite nice returns. So it's, for us, it's not really a conflict between ESG and profitability. We see them as they go hand in hand. And since two of the major risks of investing in smaller emerging markets and frontier markets would be corporate governance or government or state governance interfering, we try to look for companies that actually do good for society as well. Then they're more aligned with the interest of the government. So we see decreased risk of that being interfered with. At the same time, as we look for sectors that will have a larger part of the economy as it grows. So the corporates that we invest in will become more profitable and be much, much larger 5-10 years from now. So, yeah.
Thanks, Mathias. Alex, imagine being in an elevator. You have 30 seconds. What's your pitch?
I can't do it in 30 seconds. So we are experts in the environmental side of disclosure. And so data is absolutely key for us. We don't buy any data off third party at all. We source our own. So there's a very, very deep and so it's our own IP. It's there and built by our research teams. It's we've been going 13 years, so it's now as far as you can get really in terms of the data on water, waste, and carbon. As the data in this space is very unstructured, very complicated. There are no IFRS standards around reporting this data, and the data providers that we see and that try and sell to us are just scraping data. It's full of holes, it's full of errors, and we clean, collect, and standardize that data ourselves so we understand it. And when we don't understand it, we engage with companies. And it's that engagement, as Serge mentioned, the engagement with companies that's key. We're driving companies to disclose better. We're driving the ones that don't disclose at all to disclose. I mean, you wouldn't believe that only half of the MSCI world actually discloses data on these 3 points. So there's a huge gap, and we're pushing all the time. We're engaging with those companies to increase and get better at that. So that's as quick as I can be.
Thanks, Alex. And also nice that you again put emphasis on this notion of engagement. I think we will come back to that because if we think about how can we as investors or how can financial markets have an effect in the real economy, of course, engagement is one mechanism we should focus on, or at least think about how to organize effective engagement strategies. Yeah, thank you. Well, Ulf, I would like to hand over to you.
Okay, thank you. I would like to emphasize the industrial link we have. 40% of our companies controlled by Aker ASA. That might not be a family name for you, but it is the oldest industrial company in Norway. It was incremental in building out the Norwegian continental shelf. It has grown because of carbon. So it's the second biggest oil producer on the NCS. So they're doing this transition from an industrial perspective. They've designed verticals, companies active in carbon capture, companies active in offshore wind on the Norwegian continental shelf, and also companies active in green hydrogen. And they've also invested and realized that it's going to be extremely capital intense. So they created an asset management company on top of those verticals, because this will not only take place in the listed markets. It's actually a rather small portion, they believe, that will be on the listed markets. Lots of things will happen in private equity, private debt, and venture projects. So these guys are doing it, actually building the stuff. It's good for us to cross-reference how you calculate on industrial large-scale capex-intensive projects, which counterparts are good. So we can use that when we try to find out which exposure we should choose in the listed markets.
Thank you, Ulf. Now talking about diversity and differences in product offers, I would like to hand over to you, Craig, because I think you have to tell us a lot.
Oops. Well, so we have evolved as a business, and so we're focused in the private markets. And if you look at it from this perspective, 99% of the 6 million companies in the United Kingdom are private companies, and they are the ones that need the investment and the capital, and they can't go to the stock market to raise money, and they can't go to a bank and get a traditional loan. So increasingly, the private market sector is really filling the void. And so clearly private equity is a very big part of that, but also so is private debt. And so we focus on the debt side. And so we provide a solution for a customer that helps them to reduce their pollution, sometimes increase their profit, and critically helps them become more carbon neutral. So from this perspective, we've been quite successful, because whereas in the very beginning we were just lending money to a customer, our business has evolved and developed a significant infrastructure team of over 40 people. And what that means today is that we deliver a solution rather than just lending the money. And that means that the projects that we get involved with are more likely to come in on time and on budget, and less likely to go over time and cost and everything else. But a key element here from our side is that you get far more control and far more transparency. And the net result of all of our efforts is that we've been involved in about 50 renewable energy projects, which power about 1 million homes in the UK. And that's a real impact in the real world that is, I think, something to be incredibly proud of. And so from that perspective, with what's going on in the wider world at the moment, with perhaps the war and the real transition away from traditional Russian gas and oil, the opportunity is immense. So we're in a very good position to capture more of these opportunities in the coming years, given what we've invested in terms of the people and the process over the last 10 years.
Thank you, Craig. Yeah, I think you've seen a very diverse picture when it comes to investment philosophy, focus, utilization of data, different asset classes. So maybe you already think about some questions you want to have later on to the panelists. But before we go for that, I would like to introduce our last person on the panel, Ingeborg Schumacher. Ingeborg Schumacher nowadays works as an ESG expert. She's based in Zurich, and the two of us actually have been knowing each other for more than 20 years. Back then, she was working for UBS, also in the SRI team. And we invited her today as the ESG expert, and with the intention to kind of challenge our panelists a little bit. So therefore, Inge, I would like to ask you now, if you step into the shoes, let's say, of a potential investor for a second, and now you've heard these interesting product offers here, what would come to your mind as an investor?
Welcome from my side as well, but sorry, but before I ask some questions to you, I would really love to address some of the aspects you mentioned before on the challenges that we currently have. So I'm in the context of sustainable investing for more than 25 years, and I've seen the ups and downs in the industry. And well, you mentioned the volume has increased. That's great. On the other hand, there is more criticism on greenwashing. So it's really important to look what is behind. And you also just mentioned the current situation. And it's obvious that the current situation, well, is lowering the enthusiasm about the great performance that we have seen during the last years. So looking at some of the ESG indices, well, with an overweight in internet and mainly internet, and an underweight in energy, you saw an outperformance. But okay, what is the driver? So if it's only the sector allocation, then it's a bit risky, and you need to be aware of these risks. And therefore, I think it's important looking at these managers. They have an active allocation, and I think you can ask them later also about their allocation and if there was a shift in the allocation in this recent situation. And I can also say, due to the higher interest in sustainable investing, there are more and more challenges when you consider the discussions we had at the beginning of the year, if nuclear or gas should be included in the taxonomy that was supposed to be a kind of scientific proof what is a sustainable activity. And well, it tended that despite scientific evidence, it was more a decision from politicians to include both gas and nuclear into the taxonomy. what does it mean for investors? And looking at the current situation, well, yes, energy prices went up. There is a kind of renaissance of fossil fuel companies. You have fracking as one of the most polluting activity that will pop up again. Coal might be there longer, but you also need to look at the long-term effects. So energy reliability, local sourcing, becoming independent of geopolitical dependency is an issue that we also need to consider as a long-term trend. And so there are some turbulences in the market at the moment, but on the long-term perspective, I think everybody will agree this will be a support and a tremendous, I think, speeder for renewable energy. And I won't go into details, but yes, there have been even lobbyists that try to include weapon companies into a social taxonomy that is to be developed. Fortunately, this time, I think this won't happen. Now, after some kind of high-level comments, I would like to get back to a concept that is, I think, for me, a key within sustainable investing. And this also will have an impact on you as this means homework for you. So, well, why are there so many different sustainable investment strategies? Why are there negative criteria, best in class, impact investing? Well, the reason is, as there are so many different objectives that investors follow to invest. And within the context of sustainable investing, 3 main objectives have now been defined. The first one, the historical one, was values alignment. Just not to invest in sin stocks you don't want to be involved in. The next trend, and I think a very important part, is the question on materiality. So to identify risks and opportunities linked to ESG factors. And I think Osmosis for me is a very obvious implementation of the strategy. And the next objective that Timo had already mentioned is the question on impact. So what can we achieve? What is our result as an investor? And not only on the company, but also on the overall system. And well, after just framing the 3 objectives, I would like to ask the panelists, what is your main objective that you're following? And I assume that it might be a combination. So perhaps you can say, well, 70% impact and 30% materiality. Just give us a brief comment and a proof about your judgment.
Yeah. Thanks, Inge. And maybe just as a side note, if you wonder who has defined those 3 motivations, there was a release by a report by Amas and Swiss Sustainable Finance. You can find that in the internet. Was published earlier this year, and they lay out those 3 different motivations and link it to individual SRI investment strategies. So, but with that, I have no preference who would like to go first. I don't know. Yeah, Ulf, please.
To answer the question about impact, was that?
What is your main objective?
I mean, I think you have to be sort of self-critical here. I mean, we're not huge, but we invest all across the capital structure. Of course, I mean, being an active manager, you always try to seek dialogue with management teams to discuss business plans and investment plans. And of course, you get that's only natural, more of an impact in smaller companies. So we've engaged in workshops with those companies, and actually it is a jungle to try for a small company very busy, taking care of their own business, to also understand all these new regulations that are popping up. So maybe if we can sort of do some knowledge transfer to them, advise them maybe how they should approach this and communicate this to capital markets, in their best interest. It's one way of being active. Also, maybe if I may, this discussion about circular business models, which I think is rather interesting, and not only focusing on the energy part of this. It's actually lots of very exciting projects that can happen, creating circularity. And looking at, for instance, a very interesting Swedish company that we were funding early is called Renewcell. They're active in actually circulating the cotton out of clothing. So there's many trends out there. We use much more clothing than we've done historically. So it's actually 60% more. We spent 60% more on clothing than we did. It's actually 15 years ago. And we keep those clothing half the time compared to what we did 15 years ago. And the cotton industry is very water intense. So this company has come up with proprietary technology, where they actually are able to circulate 100% of the cotton fiber. H&M, Inditex, Levi's is shareholders in this company. So maybe this is an impact as well, to help promising technology create circular business models.
Yeah. Thanks, Ulf. So that's the direct answer then probably to Inge's question would be, from my understanding, knowing Norron a little bit, alpha is kind of the prime objective, but you also go towards the notion of impact by, for instance, dialogues, workshops, and it's some sort of a awareness rising effort.
Yeah, I mean, I would say that. And I mean, of course, they listen to us much more if the company is small to mid-sized than if we have a discussion with Atlas Copco or Sandvik or SSAB or something.
Okay, yeah, thanks. Alex, how about you? Would you like to go next?
Cheekily, I'm going to say that we tick all three boxes of this. So the value side, the business was created to invest sustainably and in a much more sustainable framework. We do have exclusion policies, but we really only exclude tobacco. That's the one thing that we will not own. And everything else is driven by a best and worst in sectors. So we invest in the best companies in their sectors in terms of their resource usage and the revenue they're generating. But we don't believe that people will invest unless there's an economic argument. So, that's where we hit the materiality tick. So, our companies, we believe, will outperform because they are using more, they're using less to create more. So it's a very straightforward argument. And thirdly, we believe that by driving change in the large cap environment, the listed, environment, that filters down all the way into the small cap and into the private market, because that's where people buy from. That's where everybody buys their goods, their inputs into their processes. So you can drive change all the way through. So cheekily, I'll take all three.
Okay. Thank you. Yeah, then, maybe, Craig, I mean, it's clear when you work in fixed income, providing additional capital, focusing on solutions, the impact notion is as really at the heart. But maybe you can tell us a little bit, what's your experience? Does this also make financially sense? What you say to the other two boxes, Inge, motivations Inge proposed?
Sure. Well, clearly we're all in business to make money. So every one of us may have ESG credentials, but I would suspect that the number one generator is alpha. So let's get that out of the way. Let's not pretend anything else. We're in the investment management business to make money for our clients. But it's how you make money which is evolving for all of us. And so from our perspective, in the UK, we've got a government that has signed into law, the first government in the world to be carbon neutral by 2050. And that's profound in many respects because there's a lot of change coming our way. And one example is that the sale of petrol and diesel cars is going to stop in the next 10 years. The relevance of that is we have about 40 million cars in the UK. So if you're not burning diesel and petrol to generate propulsion in a car, you need a lot more electricity. So this energy security is a cue to invest. So clearly, from our perspective, our number one objective is to make money for our investors, but the sort of number 1.1 is really to reduce waste and reduce pollution. And so the initiatives that we do is very much focused on that space. So I think the opportunity is immense, but there is profound change coming for all of us. And that means that we're all going to have to embrace some of this change, because some of it is going to be not just what one country does, but really a whole continent or a wider community. So I think from our side, we're very much engaged in this and we're very much committed to it, and we can see the opportunity. And so sometimes when you get these profound moments like the pandemic, which changed the world forever, and then we get into now the war, which has changed the world forever even further. What we saw with the pandemic was really a catalyst for change in terms of a renewed focus on ESG and impact and so forth, with taxonomy and SFDR and so forth. So that was the acceleration. The war really has turbocharged it. Everyone is now focused about this change. So it's buying into it in a much wider accepted consensus from different areas. So I think we're in a really good place to capture more of those opportunities. And what started off as really a niche area for us has become a much bigger opportunity for really the whole industry. And literally yesterday, whilst we were sitting on a similar stage to this in Zurich, one of my colleagues sent me an article that the European Union yesterday just literally announced that they're going to commit another 37 billion euros to tackling climate change by creating biomethane production from waste. So the timing was exquisite to sort of say, look, this is what we're doing, and here's a lot more coming our way.
Yeah, definitely. Yeah. Okay. Well, then, Mathias.
I have to agree. I mean, the most important objective for us is to provide returns for our investors. And as I said before, for us, that means that we take a longer approach. We see that demographics makes our part of the world will be the fastest economic growth we'll see over the coming decades. All new workforce will be born in Southeast Asia and in Africa. The infrastructure deficit in these countries is huge. So therefore, they will need a lot of investments and a lot of capital to bring the economic up to speed, basically. So for us, how do we reach that long-term objective to make that more sustainable? Well, it's through all three factors, basically. I mean, we have exclusions. We don't invest in tobacco or pornography or weapons. But we also see that we need to drive the awareness and the change locally as well. So we try to impact as much as we can through engagement. We do annual questionnaires and provide them with suggestions how they can improve further. We've also arranged conferences together with the local stock exchanges in Sri Lanka, in Pakistan, and in Vietnam, where we invite local NGOs, experts, the stock exchange, the companies, and ourselves to provide information on what we see as important for their growth and to attract more capital from outside investors. And that's been very, very successful. In terms of investments, it's a very limited space of number of companies we can invest in that are actually at the forefront of the change. But we tried to do so. We're one of the biggest investors in an IPO in Sri Lanka last year in a wind park constructor. So we're trying to do it on all levels, and we try to go there and show them that this is the level we expect from you. But it also has to be said that we can't really expect them to live up to the standards we have in Europe. It's just not possible. So we have to adapt all the standards to their level. But what we do is we expect them to improve every year. So even if they're best in class, they still need to improve. And if they're the worst in class, we want to see very fast improvement and continued improvement. And we also try to highlight the importance of that the corporates also start talking about these matters, because it makes society more aware of what's important, and it builds a larger force for the change.
Yeah. Thank you, Mathias. And thank you, Inge, also for raising those three motivations, because I think they really help us critically reflect on what we are doing. And Serge, coming back to what you mentioned earlier, these different dimensions of security, and we should seek to contribute to those different levels of maintaining or having secure systems, right? I'm thinking about that. I mean, as an investor, would you do that due to your own normative understanding? It's expected that I contribute to this type of security. Do I do that because I think there are the alphas, that's very profitable? Or do I do it because I think that's where I can change the world? So it's an interesting consideration. Yeah, I think there are many more questions, at least I have, but I would like to open up here for a quick round of thoughts and questions from your side regarding what we've heard so far. So please feel free to raise your hand, and I'm happy to come and give you the mic for any questions or comments. Stephan.
Okay, then I'll kick it off, and maybe there will be more questions following. I was wondering about ESG. So how do you look at the three things? Are they equally important? Are certain things more important than others? And if so, why?
Yes, yeah.
I'll start off then. I would say for us, it depends on which sector you look at. If you are talking to an IT company, their environmental impact is obviously much less than if you talk to a cement company. So that for us, that would vary. But just by looking at the three different letters, they're all equally important. They all need to be taken care of to build a sustainable society that will, create value for longer periods of time. So I couldn't really choose one of them, but the approach we have is really that we look at the companies and the sectors they operate in and adapt our standards through that.
So I would bring this back to data. So for us, obviously, we are environmental experts, so the E is critical. But we find the S and the G difficult to quantify. The questions asked on a social and governance survey are things like, how often does a company change its auditor? So you're looking at binary, very simple, straightforward. It's difficult to quantify that and turn that into an investment signal. There's no doubt there are companies you want to avoid being invested in for S&G reasons. And we try to exclude those companies when we can see them and they're clear, visible. So the UN Global Compact is a very good way to see the companies that are failing on those principles. But for us, E is the critical one, and that's where we find our data and we understand and utilize our data.
Hello?
Yeah.
We only invest in the Nordic markets, and many of the trends within S&G is obviously very well established. So of course we would like to promote them, but on the social side, it was important during the pandemic, actually, the way the company behaved and how they sort of tried to actually change production to help the healthcare system, provide free housing maybe for people in quarantine. The way people took care of their employees during that period, and actually maybe it's not with academic proof, but a short study we did was that the companies that were proactive in their approach during the pandemic actually performed better than the ones that weren't that explicit in their policies. So, but I mean, it's the business plan again that we focus on, what they're aiming to do. Also, a little advice I would say is the way you construct the portfolio, not only one single company. The way you construct the portfolio is crucial here, because you're implicitly exposed to different factors depending on if you're interested in a company in transition. That's often a traditional engineering company changing the way they behave. You have enablers with maybe a fantastic invention. Those companies are priced completely different. Mm-hmm. So you can't be, or I mean, the obvious low-hanging green utilities that are listed, they can reach silly valuations, but you have to balance that out in the portfolio, so you're not exposing yourself to too high risk in any of those factors. A balanced approach, I would say.
Craig, any final thoughts from you?
Yeah. Several thoughts, really. The first is that ESG in the United States really, in my experience, focuses on the S. And in Europe, it's much more focused on the E. And they're both virtuous, they're both good, both positive. But in my experience of dealing with Americans, they're very much focused on, the minority board representation and what you've got in terms of number of women on your board, or all these things, which is all good. But in Europe, it's all about energy and environment and climate change. And it feels that they're, in many respects, very far apart. And the definitions change. Often when you go to America, they don't even use the word ESG. They use the word impact investment. Mm-hmm. Or, you go to other parts of the world and they talk about SRI. So whereas we've heard earlier that there's striking differences between individual rating agencies, that one likes Tesla and another one doesn't like Tesla, or one likes Exxon and another one doesn't like X. You've got a similar situation here in terms of how different people interpret it. But it's a bigger issue. And the issue really here is around, essentially, at the moment, ESG is a rich world thing. It's our thing that we're leading on. But if you go, first of all, to other parts of the world outside of America and Europe, they are perhaps less focused or conscious on the words ESG. They might still be focused on the environment and the climate because it's on the news every single day of the week. But I think there's several thoughts here. The first is that there needs to be more education to really, first of all, the small business, because that 99% of the small businesses, the backbone of the economy, they don't know what ESG is. And so what you're going to see going forward is that the way that banks lend money to companies, if they can get a loan in the first place, is going to change, because they're going to have much more prescriptive and dictating criteria about, well, if we lend you this money, we need to show and see evidence of your ESG criteria. And so that, again, is where the private markets can come into this and really capture this. So I think this is going to evolve massively over the next 10 years, that the private sector will come in and say, well, we'll lend you the money, but because our investors are pension funds who insist that you must have an ESG criteria, we can only lend you the money if you have ESG credentials in your small business. And a lot of small businesses clearly don't have the time, the money, the resource to have a whole suite of ESG policies. They're just trying to get to the end of the month and make the payroll. So I think that's one key element. But there is another key fundamental element here, which applies to everyone in this room that advises clients with their money. At the moment, my 13-year-old delightful daughter is having an ethics class at school every week where they teach her and her class about climate and E and S and G. And the relevance of that is that generation is going to inherit an enormous amount of wealth in the next 20 years. And so your next generation of clients are going to be a lot more focused and insistent and demanding on, I want ESG in my portfolio. And you need to become an expert in this. And you need to be aware that this is what's coming down the road in terms of investor demand over the next few years. So we're all looking at this from today, but you have to look forward 5, 10, 15 or 20 years time. Your customer base is going to be very much more conscious about this and aware about the issues that maybe this generation is less concerned about. So I think these key elements, the education of the customer, the business that we're investing in, that we're lending to or whatever, but also ultimately the next generation of our investors are going to be way more focused on it.
Yeah, absolutely. Very good points. Thanks, Craig.